Welcome to class number 11. Today we'll be discussing American tax law, just broad terms. So what we need to know about American tax law generally is the idea of progressive taxation and who operates it and how it works in general terms, because obviously taxation is something where there are hundreds and hundreds of rules, and we can go over them. And with the vocabulary you learn today, you'll probably be able to study the norms that apply to your client, to your case specifically. Especially, if there's international tariffs being levied or you're dealing with international trade. So the taxation on income in the United States is supposed to be progressive, which means, the individuals with higher income will pay higher rates of taxes. So the tax rate would be the percentage of your income that you have to pay in the form of an income tax. And that is managed by the Internal Revenue Service, so the IRS. They are the biggest tax collection agency in the United States. The taxable income, it means that the amount of your income that is subject to taxation. Obviously that's going to vary. There are a multitude of exceptions, and there are deductions. So there are expenses that you have in your personal life which you can deduct from your taxable income. For instance, business expenses, those are not taxed, because obviously the government wants you to grow your business. You can deduct those from your tax bill. There are tax credits, if you have children, sometimes many other things. Tax bills, are always being changed and being offered around. So basically, when you hear the term tax credit, it just means you're gonna have a portion of your taxes cut off, or you're gonna gain some money back from your taxable income. Capital gains tax is an interesting tax, because it comes from the sale of an asset. When you sell an asset, such as a tax, a bond, or real estate, there is a tax on capital gains. It's an interesting form of taxation that mostly affects people who have considerable income, because owning those things is difficult. Then tax brackets, that would mean the range of income for a certain tax rate. So for instance, if you make from a certain number of dollars until a certain number of dollars, your taxable income is going to be something like 27%. So that's going to vary depending on how much income you make. That applies to most forms of taxation, but especially to the income tax. So a standard deduction, there's a fixed amount. When you itemize something, basically you're going item by item, saying I spent this much with this business expense and that much and that much. Obviously that takes time, and you should do that with an accountant, because it's a difficult thing to do. So you can just have a standard deduction instead of itemizing your deductions. Then depreciation, you can use depreciation as a form to reduce your taxable income, because if you have a depreciative asset, such as a vehicle, then your income really is going to suffer a loss because of that. And if you lose money, you don't have to pay taxes on the money you lost. You pay taxes on the money you gained. Tax treaty, between two countries, usually to prevent taxes being levied twice on the same thing, so that encourages trade. And there are taxable events, which things that happen which can be subject to taxation. The IRS, like I said, they administer the federal tax code and the federal income tax. They collect those taxes. They're a big agency. They're responsible for a lot of the government's revenue. A direct tax that is imposed directly on an individual, corporation, property. This is a distinction that is important, because the Constitution only speaks of direct and indirect taxes. So basically, this is a tax that the individual cannot pass off to the consumer, because taxes on consumption, they will usually be the factor into the price. The people who sell the product will increase the price so that they can still make money despite the sales tax. But if you have an income tax, then you cannot escape the tax. It's a direct tax. The 16th Amendment, before the 16th Amendment, any form of taxation which was direct had to be apportioned in accordance with the census data from the states. So if one state had 1 million citizens and another state had 2 million citizens, then the state with 2 million citizens had to gain twice the direct tax revenue from the state with 1 million citizens, because taxes were supposed to be distributed evenly among the states. And the 16th Amendment changed that. They said, well, the government can institute an income tax without apportioning it among the states. And that was on purpose, so that they could concentrate the money in areas where they felt it was needed most, instead of distributing it among the states. So, well, if you want to build a dam in Mississippi, you're going to have to spend more tax money in Mississippi, and you're not going to be able to give it, you're not going to be able to apportion it to the people of California or Ohio. Indirect taxes would be taxes on goods and services, which the people would be able to shift and not bear the burden themselves. So, taxes on usually sales taxes, and that is one reason why those taxes are criticized because they end up falling on the consumer, and that's bad. You want a progressive form of taxation, not a regressive form of taxation, where poor people would pay the most. Excise taxes, you have specific goods. You have alcohol is subject to more taxation than cigarettes, obviously, because those are vices. Those are things that the government wants the citizens not to do very often, so they'll levy additional taxes on top of that. Tariffs usually refer to that is a tax that is on an import good. So you hear about import tariffs. It's a huge issue in the United States, particularly in recent years. There was an attempt to have some sort of trade war with China, and they were increasing tariffs dramatically. And also, in other things, there's something called the chicken tax, which is a tariff that was levied a long time ago as a response to some taxation on poultry products in Europe. And as a result of that, there are no pickup trucks from foreign companies in the United States because of the so-called chicken tax. It's a tariff that makes it unprofitable to import foreign pickup trucks into America. So this is the Pollock versus Farmers Loan case from 1894. This is basically the case that made it necessary for the Congress to approve the 16th Amendment, because they said, well, you can only have a direct tax if you apportion it among the states. Congress did not want to do that because that would reduce their power, obviously. So basically they passed a new amendment to overcome the hurdle that had been presented by this decision. Basically just repeating that, speaking of different taxes. And this is very important, that they passed the 16th Amendment in response to this case, because that drastically ramped up the government revenue. Today, or as of 2021, because that's the data I was able to find from the US government, around 42% government budget, government revenue, not the budget, the government revenue comes from income taxation. And that used to be a lot more, because prior to the 1980s, the top tax brackets or the top tax rates were much larger. So during the World War II, there was a need to finance the war, so the top tax rate went up to 94%. But even after the war, until the 1980s, the top tax rate was 70%. So that's what allowed, for a lot of big social programs to happen through World War II and, during the Great Depression. So you had the Social Security program, you had Medicare, Medicaid, and ever since, these huge rate reductions, the government has been financing those programs with budget deficits. So it's basically issuing bonds and basically borrowing the money through those bonds. That's why there's been such a huge increase in the deficit. Well, that's one of the main reasons. Military spending plays a role. You can see there's been a huge decrease in tax revenue since the 70s because the top tax brackets have been cut several times since then. Here are a few a little bit of case law. Perhaps this is really just the basics. When it comes to tax law, you're more concerned with the actual regulations, because the case law is mostly going to be whether or not taxes were legal. But because taxes are a more objective thing, and you're more concerned with maybe the mathematical aspect of it, you're going to be more concerned with actually looking at the regulations themselves. But case law is always good, is always important. So please read this much case law and much more if you wish to work with the American tax law. All right, I'll see you on the next lesson.